$215.9 billion.
Yeah, it's a huge number.
I really want you, the listener, to just let that number sit in your head for a second. $215.9 billion in revenue.
It's hard to even wrap your head around, honestly.
Right, and that was just in fiscal year 2026. For the company at the center of today's deep dive, that is a massive 65% jump from the previous year.
Which is just, usually a mature tech giant is popping champagne over, high single-digit growth.
Exactly. So to figure out how a company grows 65% at that staggering of a scale, we tore through their FY26 10K report, their quarterly earnings presentations, and some internal analytical notes.
And what we found wasn't just a really good sales year. It's so much bigger than that.
Yeah, we are essentially looking at a blueprint for a completely new industrial revolution. So, okay, let's unpack this.
Let's do it, because the transition outlined in these documents is profound. And for anyone who still associates this company strictly with, graphics cards for gaming PCs.
He's like the old days.
Yeah, those days are a footnote. Yeah. They have fundamentally transitioned into being the master architects of global AI factories.
AI factories.
Exactly. And to contextualize the speed of this shift for you, just think about this. Since the emergence of ChatGPT back in the fiscal 2023, their data center business has scaled by nearly 13 times.
13 times. That is insane.
Yeah. That segment alone generated $194 billion in fiscal 2026.
Wow. Okay, so to understand how you even get to $194 billion in data center revenue, we really have to look at what they are actually building.
Right. It's not just servers anymore.
No, not at all. The sources keep pointing to this thing called the Blackwell architecture. And reading through the 10K, it becomes obvious we need to stop thinking about this as like buying individual computer parts.
Yeah, the old mental model doesn't work here.
Right. It's like if traditional computing is like a brilliant professor sitting in a room and it takes him a week to read an entire library of books to give you an answer, Blackwell is fundamentally different.
It's a totally different scale.
Exactly. It is like building a hyper-connected smart city filled with 100,000 college students who can read that entire library in 5 minutes, share their notes with each other instantly, and hand you a fully synthesized report.
I love that analogy.
Thanks. It's just you have hundreds of thousands of GPUs wired together to function as a single, giant, unified brain.
Yeah, and the technical term they use throughout the reports for that hyper-connected city is extreme co-design.
Extreme co-design.
Right, because you cannot run modern multimodal AI on a traditional piecemeal network. Where you buy chips from one vendor, your networking cables from another, software from a third.
Because they wouldn't talk to each other fast enough.
Exactly. The latency, those tiny microscopic delays in data transfer would completely bottleneck the system.
Right, right.
So with extreme co-design, the chips, the Quantum X networking switches, the cooling systems, the algorithms, they are all holistically engineered together to eliminate those bottlenecks.
That makes sense.
And they're already deploying this at a scale that is honestly hard to conceptualize.
Yeah.
There are currently nearly 9 gigawatts of infrastructure deployed on their Grace Blackwell NVL72 systems.
Wait, 9 gigawatts. Just for some context for you listening, that is the power consumption equivalent of several major metropolitan cities.
Yeah.
And it's entirely dedicated to computing.
Entirely. And that compute power is being consumed by major cloud service providers and massive enterprises to drive corporate digitalization.
So it's the big players buying this up.
Oh, absolutely. Yeah. And we're seeing strategic partnerships really validating this whole global AI factory vision. They're working with Foxconn to build an AI supercomputer.
Oh, wow.
Yeah, and they're partnering with Humane for infrastructure in Saudi Arabia, and they're rolling out Stargate UAE, which is a massive AI cluster in Abu Dhabi.
So this is truly a global rollout.
It is. These factories are the physical foundation allowing enterprises to run something the reports highlight heavily, which is agentic AI.
Yes. Okay, that concept of agentic AI is arguably the most critical technological leap in all these sources we looked at.
It changes everything.
It really does, because we are moving way past the basic chatbot phase. We aren't just, asking a model to write a poem anymore.
Right.
Agentic AI is when you give a system a high-level goal like audit these 50 vendor contracts for compliance risks and draft a summary for the legal team.
A complex, multi-step task.
Exactly. The system breaks that prompt down into subtasks. It assigns different AI models to read, fact-check, and summarize, and then it executes the whole workflow autonomously.
And the compute required to manage those autonomous workflows where AI models are essentially talking to other AI models in real time, it's staggering.
Yeah. I bet.
That is exactly why they need the extreme co-design of that Blackwell architecture.
So what does this all mean for their competitive edge? I look at this and my immediate thought is if I'm a rival tech giant with incredibly deep pockets and I see that $194 billion figure,
You want a piece of that pie.
obviously, I'm going to try to build my own hyper-connected city. So what is actually stopping a competitor from just reverse engineering this?
Well, the hardware is really only half the story here. Their true competitive moat is the software layer,
Okay.
specifically a platform called CUA. CUA is essentially the translation layer that allows developers to easily give instructions to the GPU.
Right.
And over the past decade and a half, they've trained millions of developers to speak this specific programming language. So they didn't just build the fastest hardware, they built the only language the industry naturally speaks.
Oh, that's brilliant.
It is. So if a competitor builds a chip that is theoretically, say, 10% faster, it doesn't matter.
Because nobody knows how to program for it.
Exactly. It's like building a slightly more efficient printing press in a world where everyone only knows how to read one specific alphabet.
Wow.
Yeah. Switching away means retraining your entire engineering workforce and rewriting your entire software stack from scratch.
Okay, that completely reframes the competitive landscape. The stickiness of the ecosystem is the actual product.
Precisely.
And what really stood out to me in the 10K is how they are taking that exact same unified programmable architecture and deploying it into entirely different multi-billion-dollar markets.
Right, because everyone focuses on the data centers.
Exactly. We get so caught up in the $194 billion data center number that it is really easy to gloss over the fact that their gaming segment generated $16 billion this year.
A record $3.8 billion just in Q1.
Right. And they're integrating this new Blackwell architecture into the RTX 50 series for desktop gamers, and they're powering the upcoming Nintendo Switch 2.
Yeah, and the automotive sector follows that exact same platform strategy.
Tell me about that.
Well, it generated $604 million in Q4, which is up 6%, largely driven by robust demand for self-driving solutions.
Right.
So they build the core parallel processing technology once, and then they leverage it across autonomous vehicles, gaming, enterprise software. But, and this is wild, the most profound application of this architecture mentioned in the 10K is physical AI.
Yes. The physical AI section felt like reading science fiction.
It really does.
I mean, they are actively providing an end-to-end platform to train and deploy humanoid robots.
Yeah. Through their Omniverse platform and the Isaac GR00T foundation models, they have essentially solved the robotics training bottleneck.
How so?
Historically, training a robot to, say, pick up a fragile object without crushing it, that required putting a physical machine in a physical room and letting it fail thousands of times.
Dropping a lot of eggs.
Exactly. It was slow and incredibly expensive.
Right, but with the Omniverse, they create this hyper-realistic digital twin of the real world.
Yes.
They simulate gravity, friction, the physical properties of materials perfectly in a digital space. So the robot's digital brain practices picking up that digital egg 1,000,000 times a second in the Matrix.
The Matrix, exactly.
Yeah. And by the time they download that trained brain into a physical titanium chassis, the robot already knows how to interact with the physical world. It is wild how simulating video game worlds, which was the company's original purpose, perfectly translated into training physical robots to navigate the real world.
What's fascinating here is how they leverage that unified underlying programmable architecture. The GPU was originally designed to simulate human imagination, figuring out how light bounces off a wall in a video game.
Right, so the player feels immersed.
Exactly. And today, that exact same complex mathematical capability is simulating human intelligence and actual physical physics for the real world.
It's incredible.
And because they use that unified software stack, a developer working on a video game engine is using tools intimately related to the tools a robotics engineer is using. It vastly accelerates the pace of innovation across their entire ecosystem.
But, okay, let's be real. Building the physical infrastructure for global AI factories and training humanoid robots requires a terrifying amount of capital.
Oh, absolutely.
To pull off a hardware scale-up of this magnitude, you need a massive war chest.
Yes, you do.
So let's look at the financial realities. Because for you listening, whether you're, managing a fund or just looking at your own portfolio, the underlying cash engine is what dictates long-term survival. Are they actually generating enough cash to sustain this?
Well, cash flow metrics are historic. For the fiscal year, they reported $102.7 billion in operating cash flow.
Wow.
Yeah. And even more telling is their free cash flow, right? The actual cash left over after paying for all their operations and massive capital expenditures.
Right.
That's at $97 billion.
Okay, but when I was digging through the balance sheet to see where that cash was tied up, a huge spike in working capital caught my eye.
The inventory jump.
Yes. Their inventory jumped 112% to $21.4 billion. And I mean, in almost any other industry, if you see a company's inventory double, alarms go off.
Oh, totally. In
Ugh.
traditional retail, that means you have a warehouse full of unsold goods that you're going to have to sell at a steep discount.
Exactly. So what's going on here?
Well, in a traditional hardware cycle, a massive inventory spike is absolutely a red flag. But the 10K provides critical context here. This $21.4 billion is a highly strategic accumulation.
Okay, how so?
Think about it. When you are building 9-gigawatt AI factories, you are dealing with millions of optical networking cables, high-bandwidth memory chips, custom cooling components, and many of these have 12 to 18-month lead times.
Oh, so they have to order way in advance.
Right. This inventory jump is them using their massive cash pile to secure supply chain commitments well in advance of the Blackwell rollout.
I see.
They're preemptively buying up the global supply of necessary components to ensure they can meet the anticipated demand extending deep into calendar 2027.
So it's actually a flex of their balance sheet to lock out competitors from the supply chain.
Exactly. And their total liquid resources, cash equivalents, marketable securities, those still sit at a very comfortable $53.6 billion.
Wow. But if I am a retail investor listening to this, the immediate question is how that $97 billion in free cash flow benefits my holdings today. Like, what does this mean for shareholder value?
It translates directly into one of the largest capital return programs on the market. Over the fiscal year, the company returned $41.4 billion to shareholders.
That is massive.
Yeah, that breaks down to $40.4 billion in share buybacks, which reduces the number of outstanding shares and makes your existing shares more valuable, plus $974 million in cash dividends.
So they are funding a global industrial revolution while simultaneously handing $40 billion back to the market.
Precisely.
Okay, I do want to push back on how some of these profitability metrics are presented in the earnings reports, though.
Sure.
Because whenever you read these releases, there's always a GAAP number and a non-GAAP number.
Yes.
GAAP being the strict, generally accepted accounting principles. And I know I'm not the only one whose cynical brain immediately assumes non-GAAP is just corporate photoshopping.
Right, the adjusted numbers.
Yeah. Isn't non-GAAP just a way for companies to hide their real expenses and make themselves look better? It often feels like management saying, hey, if you ignore all the money we lost over here, our profits look amazing.
Look, it is a very fair skepticism, and investors should always be wary of management teams that overly rely on heavily adjusted metrics to hide, like structural decline.
Exactly.
However, in this specific case, non-GAAP is essential to see the actual recurring operating performance of the core business.
Okay, explain that.
The strict GAAP rules often force companies to include non-cash expenses or sudden one-time shocks that distort how the actual assembly line is performing.
Like stock-based compensation, because the company noted they expect $1.9 billion in stock-based compensation expense starting in Q1 FY27.
Right.
And that dilutes shareholders, which is a real cost, but it doesn't actually remove cash from their bank account today.
Precisely. But the most vital example of why non-GAAP matters in these sources is a sudden, one-time $4.5 billion charge they took in the first quarter of fiscal 2026.
The $4.5 billion charge, let's talk about that.
Yeah. If you only looked at the strict GAAP gross margin for that quarter, it temporarily plummeted to 60.5%, which on paper would suggest their manufacturing costs suddenly spiraled out of control.
But their manufacturing didn't break down.
No.
That $4.5 billion charge was a pure geopolitical shock. Because even with over $200 billion in revenue, this company is highly vulnerable to international trade policies. And we see exactly how fast that can hit the balance sheet.
Yeah, and looking purely at the financial reality of the trade policies outlined in the 10K, the U.S. government informed the company in April 2025 that it required a new export license for the H20 chip.
And the H20 was specifically designed for China, right?
Exactly. It was an integrated circuit specifically engineered to comply with previous export thresholds for the Chinese market.
So the moment that new license requirement dropped, demand for the H20 in China just vanished overnight.
Instantly.
Leaving the company with a $4.5 billion charge for excess inventory and purchase obligations.
Yep.
And the bleeding didn't stop there. They estimated a forward loss of approximately $8 billion in revenue for the following quarter because they literally, legally, could not ship the product.
And this is exactly why that non-GAAP margin of 71.3%, which excludes that sudden geopolitical penalty, is much more reflective of their actual manufacturing efficiency.
Because the assembly lines were fine.
The assembly lines were humming. The global trade map just changed overnight.
But, the long-term risks outlined in the 10K are far more concerning than just a single bad quarter of written-off inventory.
Very true.
The report states clearly that as of the end of fiscal year 2026, they are effectively foreclosed from competing in China's data center computing market.
And if we connect this to the bigger picture, the real danger here connects directly back to that competitive moat we discussed earlier.
The CUDA software ecosystem.
Right. The 10K explicitly notes a massive unintended consequence of these export controls. By locking this company out of the Chinese market, they are forcing Chinese developers to step in and fill the void with domestic hardware.
Oh, wow. So they are inadvertently helping Chinese competitors build larger developer ecosystems.
Exactly. If an entire generation of developers in a massive global market is forced to learn and build on a competitor's architecture, you are essentially incubating your own fiercest rival.
You are forcing them to build their own printing press and their own alphabet.
Yes.
Here's where it gets really interesting, though. Even if geopolitical tensions ease, turning the tap back on isn't simple.
No, it's not.
Because the reports detail that if the U.S. government eventually grants licenses to ship newer chips like their H200 to China-based customers, those chips must first go through an inspection process within the United States.
Right, which triggers a tariff.
Exactly. A 25% U.S. import tariff upon entering the country. And the company explicitly notes that they might not be able to pass that 25% cost on to the customer.
Which would be a direct, brutal hit to their gross margins.
Add to that the geographic concentration of their supply chain. They rely heavily on partners in Taiwan and South Korea for manufacturing and memory chips.
Yeah, their ability to maintain those mid-70s gross margins is entirely dependent on stability in the Asia-Pacific region. Any severe supply chain disruption or new export control there would fundamentally alter their financial projections.
It is an incredibly delicate tightrope. I mean, they are building the infrastructure for the next century, but the foundation sits squarely on a geopolitical fault line.
It really does.
So with these massive risks in the East, the obvious question is how they intend to protect shareholder value and ensure long-term growth.
Well, based on the Q1 FY27 projections, their strategy is to simply out-innovate the geopolitical friction.
Okay, how so?
They are anticipating $78 billion in revenue for the upcoming quarter, and they're projecting gross margins to stabilize back around 75%.
So they bounce right back.
Exactly.
Right.
They cannot dictate international trade law, but they absolutely control the pace of the global technology roadmap. And they aren't pausing at Blackwell to let the market catch up.
Right, they've got the next thing lined up.
Yeah. They have already shipped samples of their next massive architectural leap, the Vera Rubin platform.
Vera Rubin.
Yes, which is expected to commence production shipments in the second half of fiscal year 2027.
And the Vera Rubin platform is fascinating because it is optimized specifically for that multi-step agentic AI we were talking about earlier.
Right.
The headline metric they shared is that Rubin promises up to a 10x reduction in cost per token compared to Blackwell.
10 times. That's massive.
It really is. If you drop the cost of processing AI data by a factor of 10, you completely change the enterprise math. You aren't just making existing chatbots cheaper to run. You are making incredibly complex autonomous AI agents economically viable for mid-sized businesses, not just the mega-cap tech giants.
It totally democratizes access to agentic AI workflows. And to capture that massive upcoming demand, they're deploying their cash pile aggressively.
They bought Grok, right?
Yes. The sources detail a $13 billion acquisition of Grok. They are integrating specialized hardware and software to further solidify their ecosystem advantage.
Right.
But beyond corporate enterprise demand, the sources reveal a massive new growth vector that fundamentally changes how we think about tech sales.
Sovereign AI.
Sovereign AI.
Yeah. We are seeing nation-states realize that AI compute isn't just a corporate IT expense, it is core national infrastructure.
Absolutely.
We saw in the notes that they opened a research center in Japan hosting the world's largest quantum research supercomputer. Alongside those massive infrastructure deals in the UAE we mentioned earlier, governments are buying these AI factories outright.
because nations are recognizing that to remain economically competitive and secure in the 21st century, they must have indigenous AI capabilities.
Right.
A country needs to be able to train foundational models on its own native languages, its own cultural history, and crucially on its own physically secure networks.
Right.
They cannot rely entirely on a cloud server sitting in another hemisphere.
Makes total sense.
So this company has positioned itself perfectly to be the primary contractor selling these smart cities of compute directly to sovereign nations.
It's just wild. So, to bring all these threads together for you listening, we are analyzing a company that has executed a flawless, historic transition from manufacturing graphics cards to becoming the master architects of global AI infrastructure.
Truly historic.
They are generating over $100 billion in operating cash flow, locking up global supply chains, returning over $40 billion to their shareholders, and pushing the bleeding edge of physical robotics and agentic AI.
Yep.
And they are managing to sustain 65% growth while navigating one of the most restrictive geopolitical minefields in modern corporate history.
It is a level of scale and strategic execution that we rarely see. And, as we watch this space evolve, it raises an unavoidable structural question.
What's that?
The company's leadership noted that countries are beginning to view AI as essential infrastructure, on par with electricity or the internet.
Right.
So if AI compute is truly becoming a fundamental utility, what happens when computing power becomes a nationalized geopolitical resource like oil or fresh water? Yeah. How will global relations and trade alliances shift when a country's entire GDP growth potential is directly gated by its access to the latest GPU architectures?
That is a wild thought experiment. I mean, when the very ability of a nation to reason, to automate, and innovate is determined by its access to a specific piece of silicon, the entire global map gets redrawn.
Exactly.
Well, thank you so much for joining us on this deep dive. For you listening, keep questioning the data around you, look closely at the ecosystems driving your portfolio, and we will catch you on the next one.